$52 or $62 silver price. Soon, two numbers, one market, and in the next few weeks, only one of them survives. Somewhere between a collapse and a breakout, the entire precious metals world is holding its breath. Central banks are moving, currencies are cracking, and a chart pattern 7 months in the making is about to force a decision no one can delay any longer. Some analysts are calling for $48. Others are calling for $63. But almost none of them are asking the one question that actually matters. What happens to everyone who guesses wrong? By the end of this video, you will understand why this moment in the silver market may be remembered as the line between those who prepared and those who didn't. Welcome to Currency Arc Insight, where we break down the forces moving global markets before the headlines catch up. If this is your first time here, consider subscribing so you don't miss the next warning before it becomes the news. And tell us in the comments, which city, which country are you watching from today? For the past 7 months, the gold market has been sending a signal that most casual observers have completely missed. While headlines focused on daily price swings and short-term noise, something far more important was quietly building underneath the surface. Analysts who study long-term chart patterns began to notice a shape forming on the gold price chart that traders call a wedge. Some call it a sideways pyramid. Whatever name is used, the meaning is the same. Price is being squeezed into a smaller and smaller range, coiling tighter with every passing week, until it eventually has no choice but to break out in one direction or the other. This is not just a technical curiosity for chart enthusiasts. It is a structural warning. When a market consolidates for this long, it usually means large participants are quietly accumulating positions before the next major move. Retail investors watch the price and grow bored or frustrated by the lack of action. Meanwhile, institutional players continue building exposure, waiting patiently for the eventual breakout that smaller investors will only notice after it has already begun. What makes this moment particularly significant is a second signal appearing alongside the wedge pattern. Analysts have pointed to a divergence forming on the relative strength index, a momentum indicator used to measure the underlying strength behind a price move. In simple terms, even as the gold price drifted sideways or dipped lower over recent months, the momentum reading behind that price has been quietly trending upward. This is known as a bullish divergence, and historically, it has appeared before major upward moves, rather than during periods of continued weakness. Business-minded observers should understand why this matters beyond the world of trading charts. Gold has functioned for centuries as the ultimate measure of trust in money itself. When gold begins showing signs of an impending breakout, it often reflects deeper concerns building within the global financial system. Concerns about currency stability, government debt, and the true value of paper money. For entrepreneurs and business owners, this is not simply a commodity story. It is an early warning system for the economic environment they will be operating in over the next several years. Silver, meanwhile, presents a more complicated picture in the short term, and this is exactly what has created the current confusion in the market. While gold has been slowly building its case for a breakout, silver has experienced far sharper volatility. In a single recent trading session, the price moved from lows near $56 to highs approaching $59. A dramatic swing that left many investors uncertain about what comes next. This kind of volatility is not unusual for silver. It is, in fact, one of the defining characteristics of the metal. Silver trades in a much smaller market than gold, which means it takes far less capital to move the price significantly in either direction. This is where the two competing scenarios emerge, the $52 scenario and the $62 scenario. Some analysts believe silver needs one final flush lower, a move that would shake out weaker holders and short-term speculators before the metal can build a stable foundation for its next advance. Others believe the market has already built enough of a base and is ready to push directly through resistance toward the $62 level and beyond. Importantly, both camps generally agree on one thing, that any move lower would likely be temporary, and that the longer-term direction remains upward. For business audiences trying to make sense of this, the key takeaway is not which exact number silver hits first. The key takeaway is what this pattern represents. A market that has held above a major long-term breakout level for months, despite repeated attempts to push it lower, is a market that has fundamentally changed character. 1 year earlier, silver traded below $40 an ounce. The fact that it now holds firmly above $50, even during periods of sharp volatility, suggests that a new higher range has been established, and that pullbacks are becoming buying opportunities rather than signals of a larger breakdown. This is the foundation upon which the rest of this analysis will build. Gold is showing the early technical signs of a major move. Silver is caught between two dramatic short-term outcomes, both of which point toward the same longer-term conclusion. And underneath both metals lies a deeper story involving currencies, central banks, and a level of global economic uncertainty that most casual observers are only beginning to recognize. In the next section, this analysis turns to a pattern that repeats itself far too often in the silver market, a pattern involving overnight rallies and daytime reversals, and what this recurring behavior reveals about how price discovery actually works in a market this small. There is a pattern in the silver market that repeats itself often enough that serious observers have stopped calling it a coincidence. It usually begins on a Sunday evening when markets in Asia open for the trading week. During these early hours, with lower trading volume and fewer major institutions active, the price of silver frequently drifts higher. Sometimes the move is small, sometimes it is dramatic, climbing nearly a full dollar in a matter of hours. For a brief window, it looks as though the metal is finally ready to make its long-awaited move. Then London opens, then New York opens. And somewhere during those hours of heavier institutional trading, the gains from the overnight session are slowly and sometimes quickly erased. By the time the average investor checks their phone during a lunch break, the excitement from the overnight rally has often vanished entirely, replaced by a chart that looks almost identical to where it started the day before. This is not a one-time event. It is a recurring cycle that experienced market watchers have observed for years, and it raises an important question for anyone trying to understand how prices in this market actually behave. Why does a market with such strong underlying fundamentals, rising demand, tightening supply, and growing macroeconomic uncertainty, continue to experience these repeated daytime reversals during the exact hours when the largest volume of paper contracts changes hands? The honest answer is that silver, unlike many other assets, trades primarily through futures contracts on exchanges like COMEX, alongside a large volume of trading through the London Bullion Market Association. These markets allow enormous positions to be taken using contracts that represent far more silver on paper than physically exists in vaults ready for delivery. This is not a secret conspiracy theory. It is a well-documented structural feature of how the modern precious metals market functions. A relatively small amount of real capital can move the price significantly in either direction, simply because the paper market is so much larger than the physical market beneath it. For business-minded viewers, this concept should feel familiar. It resembles what happens when a company issues far more shares or promises than it can actually deliver on. For a period of time, the system holds together because confidence remains high and few people ask to redeem what they are owed. But eventually, if enough participants request the real underlying asset rather than the paper claim, cracks begin to appear. Silver's physical market operates under a similar tension, where paper trading volume dwarfs the actual metal available for delivery. This explains why short-term price action in silver can feel disconnected from the powerful long-term forces driving the metal higher. It also explains why so many seasoned analysts, despite their overall bullish outlook, continue to warn that a temporary drop toward the high 40s or low 50s remains entirely possible before any major breakout occurs. Rather than viewing this as a contradiction, experienced observers view it as a normal part of how this particular market clears out weaker participants before its next advance. History offers a useful comparison. In previous cycles, silver approached the $50 level, only to be pushed back down sharply, discouraging an entire generation of investors from believing the level could ever be broken. This time, something different has happened. Despite repeated attempts to push the price lower, silver has managed to hold above that same historic breakout zone for several consecutive months. This single fact, more than any short-term daily movement, tells a much more important story about where genuine long-term demand now sits. For entrepreneurs and business leaders watching this unfold, the lesson extends beyond silver itself. Markets that appear irrational or manipulated in the short term are often simply revealing the difference between paper promises and real tangible value. Understanding this distinction is not just useful for commodity investors. It is a broader lesson about risk, patience, and the difference between short-term noise and long-term structural change, a lesson that applies just as much to running a business as it does to reading a price chart. With this pattern now established, the analysis moves toward an even larger force operating quietly behind these price swings, one involving central banks, currency interventions, and a level of coordinated monetary action not seen in decades. Understanding this next layer is essential to understanding why silver's story is no longer just about silver at all. To understand what is really happening in the silver market, a person has to look beyond the metal itself and towards something far bigger, the condition of the world's major currencies. What is unfolding right now is not simply a story about gold and silver charts. It is a story about governments and central banks quietly fighting to hold their own money systems together, and precious metals are simply reacting to that deeper struggle. The clearest example of this can be seen in Japan. For decades, Japan kept interest rates near zero, allowing large financial institutions around the world to borrow Japanese yen cheaply and invest that borrowed money into other assets, including stocks, bonds, and various financial instruments. This strategy became known as the yen carry trade, and for years it worked smoothly because Japanese rates stayed low while other returns stayed comparatively higher. But recently, Japanese bond yields have started rising sharply, even as both the Japanese and United States governments have stepped in with coordinated efforts to support the yen. Reports describe this as one of the largest currency interventions in decades, with the United States Treasury reportedly selling euros and buying yen through major financial institutions in an effort to stabilize the currency. For a business audience, this detail carries real weight. When two of the largest economies in the world feel compelled to intervene directly in currency markets, it signals that something beneath the surface is far more serious than ordinary market fluctuation. Free markets, by definition, are not supposed to require this level of coordinated rescue. The fact that it is happening at all suggests that policymakers are genuinely concerned about a much larger problem building within the global financial system. At the same time, on the other side of the world, China has been making its own significant moves. The People's Bank of China recently announced a cut to the reserve requirement ratio for many of its financial institutions. In practical terms, this means banks are required to hold less money in reserve, freeing up additional capital that can then flow into other areas of the economy, including the metals markets. This kind of policy is typically used when a central bank wants to encourage more lending and investment activity, often because underlying economic conditions require additional support. Alongside this policy shift, reports have emerged showing a dramatic increase in the premium Chinese buyers are willing to pay for physical gold jewelry, with some data suggesting the premium has grown many times larger than usual in a short period. This detail matters because it reflects genuine consumer behavior rather than speculative trading. When ordinary people are willing to pay significantly more for physical gold, it often signals a deeper shift in how a population views the safety of their own currency and financial system. When these events are viewed together, a clearer picture begins to form. Japan is fighting to defend its currency. The United States is directly involved in that defense. China is simultaneously loosening its own monetary policy, while its citizens increasingly seek out physical gold. None of these events are happening in isolation. They are connected threads in a single unfolding story, one where confidence in paper currency systems is being tested in multiple regions of the world at the same time. This is precisely why precious metals analysts increasingly describe the current environment using the phrase fiat fiasco, a term used to describe a system where multiple government-issued currencies are simultaneously showing signs of strain. For entrepreneurs and business owners, this is not an abstract academic concept. Currency stability affects borrowing costs, international trade, supply chain pricing, and long-term planning for any business operating across borders or relying on imported goods. History has shown repeatedly that periods of currency stress tend to drive investors and everyday citizens alike toward assets that cannot be printed or created out of thin air. Gold and silver have filled this role for centuries, not because of tradition or sentiment, but because their supply cannot be expanded the way currency supply can. As multiple currencies show simultaneous signs of strain, the pressure naturally begins flowing toward these limited, tangible assets. What remains to be explored, however, is an even larger and more structural issue sitting quietly behind all of this currency stress, one involving national debt levels that are now approaching a historic milestone. Understanding the scale of this debt and what it means for future interest rates and monetary policy is essential to understanding why so many serious analysts believe the current environment represents far more than a temporary market cycle. Beneath every currency intervention and every central bank policy shift discussed so far lies a much larger and more permanent problem, one that rarely makes headlines until it becomes impossible to ignore. That problem is government debt. And right now, the United States is approaching a milestone so large that many economists believe it will eventually force a reckoning few people are prepared for. The national debt of the United States currently sits near $40 trillion. To put that number into perspective, it works out to roughly $350,000 owed per taxpayer. For years, this number has grown steadily larger, and for years, most people have simply ignored it, assuming that because nothing dramatic has happened yet, nothing dramatic ever will. But debt of this size does not simply sit quietly forever. It behaves like a slow-moving weight pressing down on the entire financial system. And at some point, that weight begins to affect everything else. The clearest danger lies in interest rates. Currently, the interest expense on the national debt already consumes an enormous share of total government income. And that expense was calculated using historically low borrowing costs from previous years. If interest rates continue rising, and if that debt eventually needs to be refinanced at those higher rates, the annual interest expense alone could double. For a government already struggling to balance its budget, an increase of that size would create what economists often call a debt spiral, a situation where a government must borrow more money simply to pay the interest on money it already borrowed. To make this concept easier to understand, it helps to think about it the way a business owner might think about credit. Imagine a small business owner who agrees to pay employees and vendors using handwritten notes instead of cash, each note promising a future service or product in return. For a while, everyone accepts these notes because they trust they can eventually redeem them for something real. But if that business owner keeps printing more and more notes without ever increasing what the business can actually produce, People eventually start asking a simple but dangerous question. Can all of these promises actually be honored at the same time? Once enough people ask that question and stop trusting the answer, the entire system built on those notes begins to break down. Government-issued currency operates on a strikingly similar foundation of trust, and history shows that once that trust is questioned at scale, it becomes very difficult to restore. This is precisely why many long-term investors turn toward historical comparisons between hard assets and financial markets. One useful measure looks at the ratio between a broad commodities index, which includes gold and silver, and a major stock market index like the Dow Jones Industrial Average. At various points in history, particularly in periods like 1980 and 2011, this ratio climbed dramatically higher than where it currently sits today. In simple terms, this suggests that commodities, including precious metals, remain historically undervalued when compared to paper financial assets like stocks. If history were to repeat even partially, the implication is that gold and silver could still have significant room to rise relative to other investments, regardless of short-term price swings. For business leaders and entrepreneurs watching all of this unfold, the takeaway is not simply about buying a particular metal or making a short-term trade. It is about recognizing a broader pattern, one where growing debt, currency stress, and central bank intervention consistently push economies toward the same historical outcome, a gradual loss of confidence in paper promises, and a renewed appreciation for assets that cannot be created out of thin air. None of this guarantees a specific price target in the days or weeks ahead. Markets remain unpredictable in the short term, and volatility should be expected rather than feared. But when debt reaches historic extremes, when multiple major currencies show simultaneous signs of strain, and when historical valuation ratios suggest hard assets remain deeply undervalued, the broader direction becomes far easier to understand, even if the exact timing remains uncertain. What began as a simple question about whether silver would move toward $52 or $62 has, upon closer examination, revealed something much larger, a global financial system under mounting pressure, searching for stability in an era where trust in paper promises is being tested more seriously than at any point in recent memory.